Welcome, Simon, Mark, good to have you. We're in for a bit of a long journey, but I reckon the three of us can do it. So we're going to talk about Australian equities market. Let's set the scene. The scene is that over the last 12 months, the Australian 200 has performed to 11% up plus dividends. We hit 9,000 for the first time back in August. I think it was August 21. We're almost holding on there. We've come off a little bit. Over the last 2 years, it's been 21%. Not as good as our North American or European colleagues, but going fairly well. And at my end of the market, the small ords, well, they've done 24% in the last 12 months. So things are starting to heat up after a very, very long drought in that area. Official interest rates, we've had 3 cuts. We might get some more, so rates are coming down. Economic growth was a little bit stronger in the June quarter than anyone thought. So not a bad backdrop to start the conversation. Now, I've got to get these two a bit more excited, I think, but I've tried my best there. Now, Simon, I'm going to start with you. We're going to talk about the market in general. Now, recently you said in an article you would rather stick pins in your eyes than invest in CBA. So I was sitting at home last night and I thought, I wonder if Simon's run out of pins. So I scurried around the house and I was able to find a handful of pins. So you take that just to keep your inventory levels up.
That's very kind of you.
So on that kind of note, it's probably a good starting point. Simon, your view on the market. I don't want you to do it here. I don't want you to scare our guests.
I think I might need to, though.
A good starting point for our conversation. Very top-heavy market in Australia. Obviously, CBA, biggest company, had a terrific run over the last few years, expensive compared to its peers globally and its peers locally. So what's your feeling, and you've obviously done a lot of work around that top-end nature of the Australian market and maybe some of the pitfalls around that?
Yeah, I guess it's nuts that they're priced the way they are for the growth that they're delivering. It's not just CBA. There's a few pins here. We could pick holes at Wesfarmers and Goodman Group, and basically the top end of the market has rallied to a level which is not supported by underlying fundamentals. You mentioned we had lagged the overseas markets, but the big difference is that in overseas markets, earnings growth has been far more significant than here. So you're getting, for very similar multiples, if not lower multiples, much greater growth levels. And it's not true of most of the, call them blue chips, that exist in Australia. So yeah, I mean, CBA is an example, Wesfarmers, Goodman Group I mentioned, the other two, at least 2 of the other 3 banks, NAB and Westpac, they're all very, very expensive companies. And so it was reassuring to see the poll results where a lot of people were trying to get exposure away from the ASX 20 and outside the ASX 100.
Okay, let's put some meat on that bone. You've done, stay with you, Simon, because I know Mark's got some comments about this as well, but some meat on the bone. Performance over the last few years, the top 5 stocks have disproportionately out-delivered without a lot of earnings growth.
Yeah, that's right. And it really manifests itself in the 2024 financial year and then on in 2025. So the degree of outperformance has been formidable. It's far exceeded the earnings growth of the companies. In fact, the earnings growth of those 5 companies, I mentioned them, 3 of the 4 banks, Goodman and Wesfarmers, and their earnings have actually collectively gone backwards over the last 5 years, but their prices have gone up a lot. So there's been some significant multiple expansion. In fact, I think by our numbers, Goodman Group, Wesfarmers, and CBA together trade at 27 times next year's earnings. They are close to 20% of our market, so not small. And there's a company you may have heard called NVIDIA that also trades at 27 times next year's earnings. And it's vilified in the press as being expensive, but it's growing its earnings also at 27% per annum, whereas those other 3 companies are growing at 6% per annum collectively. So, for us, it's a hard pass to that same segment of the market. We think there's much greater value elsewhere. But there's a lot of price-insensitive flows coming into the market that is driving some of these things ever higher. But and I think this is going to be heresy relative to what the previous speaker was mentioning, whose talk I didn't, sorry, two previous speakers, Victor. At the end of the day, the maths does hold. You can't have trees grow to the heavens, and sooner or later, fundamentals must come home to roost.
Probably a good time to bring you in, Mark. You get to look around the world, not just stuck in little old Australia. I've had a few conversations over the last little while, and you feel a similar kind of disproportionate, expensive nature of the Australian market, and you put it in simple terms, a PEG ratio, which is price for growth. Do you want to run through that for us and what you think about that?
Yeah, sure. So, yeah, I've never been more grateful to have a global mandate and not be confined to Australia. If you look at the Aussie market, we're trading around 20 times earnings, which is the highest multiple that we've ever traded in the last 40 years. It's only ever traded at that level twice before. Once was, both of them are anomalies. Once was during the dot-com boom, just before the crash, and the other time was in COVID when the earnings were temporarily depressed. So they're both a bit of a weird example. And if you look at the last 40 years, the average multiple is less than 15 times, and today we're close to 20. And for that 20 times earnings, you're getting about 6.5% earnings growth. So in PEG terms, a PEG of 3. So effectively 20 divided by the 6.5 gets you to 3. If you compare it to NASDAQ, which is a more expensive market, it's about 30 times earnings, but earnings growth for NASDAQ's about 15%. So it's about a PEG of 2. And then again, if you look at Europe, Europe's on about 15 times, but you're getting about 10% earnings growth. So a PEG of 1.5. And you can, I totally agree with what Simon was saying, that you look at equivalent companies overseas, whether it's CBA at close to 30 times and 3.5 times book value, and you compare that to Lloyd's, which generates a higher ROE, it's got 20% earnings growth, it's got double the dividend yield, it's got a more conservative balance sheet, and you're paying a P of 7. So it's really hard in that vein to say, I want to put my money in CBA. And if you're in a passive fund, you're putting more than 10% of your money, close to 12% of your money into CBA because it's the biggest stock in the market, not because it's a great investment. So,
and that reflects in your portfolio where you can sell stocks. So Australia's a net zero, so you're long and short, but you're not exposed to the Australian market compared to the overseas markets.
Yeah, that's right. We've had our fund going for 11 years. It's the lowest net long we've ever had to Australia, so it's a net long of close to 0, and all of our long exposure is expressed overseas. So it's whether it's UK, where we see stocks like Lloyd's and NatWest in the bank sector, whether it's European infrastructure stocks that are far more compelling than Australian equivalents, whether it's the resources names in Canada that trade on far more attractive valuations, have better production growth, in some cases better management teams. To us, it's a relatively straightforward decision at the moment.
And that probably is a bit to do with lack of supply in Australia. There's not many options, a lot of money chasing very few stocks. Valuations go up.
Yeah, I think one easy example for people to understand is, I think every fund manager would agree that the outlook for copper is really attractive. If you're confined to Australian equities and the ASX 100, you've got a grand choice of one copper stock to invest in. Do I invest in Sandfire or not? Now, that's a pretty terrible choice as a fund manager to show your skill when you've got a choice of one stock. If you can look globally, you might have 30 different stocks in the copper space you can choose from. So you're really restricted if you're confining yourself to 1 or 2% of the global market.
Okay, let's go somewhere where things are glittering at the moment, and that's gold. We'd be negligent not to mention gold. It built Victoria, where you come from, Mark. It probably was the main reason Western Australia got built, dear to Australians' heart, and it's at a record price. We've seen the US gold price almost touch 3,700, I think, which is a record. Translating to Australia, it's even higher. You've set up a gold fund separately recently. So views on gold, and is there value there to find in Australia and globally?
Oh, is that for me?
Oh, no, that's the Mark.
Oh, to me, sorry.
Yeah.
We'll
get to Simon, he's got a view on it.
We definitely like gold. So our gold fund's been going for 6 months. It's up more than 65%, and that's with a hedge against the gold price. So we've got insurance there in case the gold price pulls back. I think what the market's missing at the moment is that I don't think the generalists have really got involved. A lot of the resource bugs have got into it, but I don't think the average fund manager in America or Europe is really talking gold stocks. They're still talking tech stocks and AI. And the structural demand for gold is almost unstoppable. If you look at the reallocation from US dollars to gold that you're seeing from the likes of China and India, where they've got less than 10% of their central bank reserves in gold, compared to every Western central bank that has 65 to 70% of their reserves in gold. And when you think about what's happening with tensions between the US and China, that feels like it's a one-way trade for a very long time. The other thing I think the market's missing is that the Aussie gold stocks we don't think look as compelling as the offshore ones. So if you look at the mid-cap gold stocks overseas, even if the gold price was to pull back from almost 3,700 to even the high 2,000s, they're still great investments. They're still generating massive cash flow, massive earnings increases that are coming. And the stocks that we're looking at, they've typically got 50 or 100% increase in production. In some cases, like K92, they're going to triple production. So we think you're getting this amazing combination of expanding margins, expanding cash flows, unbelievable balance sheets. And the market is sort of like, oh, I've missed it, it's too late. We definitely don't think it's too late.
Okay, Simon, we'll bring it back to home and stick with gold. Newcrest was Australia's biggest gold company, was taken over by Newmont and listed here. Newmont was one of your big holdings over the last few years. Have you got a view on gold now, given how high the price has gone in terms of history, records?
Yeah, I mean, thankfully we do own Newmont and have owned it. Otherwise, I'd be crawling on my knees begging for forgiveness from our clients. But putting aside the macro attractions to gold, I agree with Mark. If I look at, there's not enough pins in here to address the domestic gold producers. They trade, at the current gold price, they trade at multiples of free cash flow that exceed their reserve and resource lives. And so by buying some of these mid-cap gold companies in Australia, you're betting on two things. Either successful exploration, which has not been forthcoming in Australia, or much higher gold prices. That may well come to hold true, but it's a more awkward position to take now than when gold prices were, say, $1,200, $1,300 an ounce. So I like gold for a lot of the reasons Mark has said, but I think it's much easier to find value overseas as well. And most of the gold companies in Australia, I don't think are worth trouble.
We couldn't get a buy out of either of you there either. So let's go to maybe general commodities. Mark, you're fairly bullish, I think, to read you correct. Maybe if we strip out iron ore, which is obviously got its own system going into China there, but the rest of the commodities, we've got an energy transition globally going on. You like other commodities such as uranium, copper? You've mentioned copper. And are there options in Australia in those areas?
Yeah, we're not blanket positive resources across the board. It's very commodity specific. And the ones that we like are typically where it's very slow to get supply to come online. And gold is a great example. And copper, best case, if you do the most amazing drill results today, if you're producing in a decade, you've done a great job. So it's a very, very difficult, it's not like lithium, where in the case of lithium, you had all these sources of supply that came on really quickly. Within a few years, you basically had a glut from an extreme shortage.
So do we stay out of lithium?
Lithium's hit an extreme low in terms of pricing.
Yep, it's at the other end.
You need to have a view on how the Chinese are going to play things in terms of their low-cost supply. I think what we saw recently is effectively the Chinese pulled back on a bit of their production, which gave people hope that we've finally seen the bottom in lithium prices, and we saw that recovery of about a 50% rally, but the price down 90% over a couple of years. So, most people are still barely making any money in the sector. So our view is that lithium will recover over the next couple of years, but it's going nowhere near the levels that we saw previously. So it's probably like curb your enthusiasm.
Right, curb your enthusiasm. And I derailed you there. You were talking about other commodities, so...
The ones we like are copper. We've been positive on copper for the last couple of years. We think that there's a structural shortage that's looming as, obviously everyone knows about AI and data centres, and effectively a data centre is just a massive block of copper that's sitting in a factory. And these data centres are getting put up incredibly rapidly. Companies like Microsoft are spending $80 billion of capex a year, and that's basically going to NVIDIA chips and copper. So we think that given the supply lags that occur in copper, we think there's a really good outlook. The best names we think are Hudbay and Capstone, which are listed in Canada. Capstone's actually dual listed now in Australia. The other example is uranium. Uranium's it's sort of like torture for a fund manager. You can see this fantastic outlook for the commodity, and then you look at the individual companies and it's excruciating because it's a bad asset, it's an unreliable management team, it's a bad balance sheet, it's everything you don't want.
Stocks never work.
So my 2 cents worth would be very careful within the uranium space. The commodity's great, but be super careful on the stock. Our favourite stock within the space is called NextGen. It's a Canadian asset. It's not producing yet, but it is the biggest and best uranium asset in the world. They'll be producing 30 million pounds of uranium in a 180 million pound market. It's got a cost of production. The company says $10 a pound. We think it'll be closer to 15 to 20. But even with that, when we first modelled the stock, we thought a $75 uranium price was about right. Today, if I sit here, I'd say over $100 is probably more realistic. So that mine by itself, if you do 30 times, call it $80 US of margin, that's 2.4 billion US of value that mine's going to be generating. We bought into the stock at 2 bill market cap. Today it's a 6 bill market cap. That could easily double or triple without sort of being too aggressive on forecasts. So that's good jurisdiction, low cost producer, and the drilling they've done next to their deposit is just as good as what they've already got in their 30 million a year deposit.
Simon, the way I grew up was that commodities ran when there was world growth around. We're not in a strong world growth scenario. The US is slowing, China's been slowing for quite a while, Europe's in a bit of a funk. For you, are commodities exciting?
Yeah, so
I'm talking about base minerals.
Yeah, well, so given my investment universe, I'm restricted to the sandfire resources of the world. So we don't own sandfire, but there are some commodities we're very attracted to. And in a similar AI theme, aluminium would be one of them. So I would defer to Mark in as far as saying that data centers are just a big lump of copper. There's a lot of aluminium that gets the electricity there because it's lightweight and it's not as conductive as copper, but its lightweight properties give it a leg up for long transmission and distribution. And of course the commodity has for, I would say, the better part of the last 30 years not generated an economic return because China has increased its supply. It has now capped its supply at 45 million tons per annum, and we think the installed base of aluminium smelters should do quite a lot better over the next 30 years. I believe Victor said this time is different, and in all things aluminium, we hope it is. But so if we can invest in low-cost smelting assets and refining assets, that's quite attractive to us. If the balance sheet can withstand the troughs that inevitably come from time to time. So that's one area we're quite exposed to, aluminium. And then, some of these other base metals, nickel has been hollowed out by all things in Indonesia.
It's been difficult, hasn't it, to pinpoint it, as Mark said. But both of you are just off reporting season in Australia. I think it was tough for the big end. For the small guys like us, it was probably the best reporting season I can remember.
Yep.
And when I chatted to both of you both were fairly negative on the scenario that was unfolding. While at my end, I was thinking I haven't seen this kind of excitement for a while. So a bit of a dichotomy there, which has changed over the years. Mark, what were some of the themes you got out of reporting season, which is always very informative?
We're really lucky. We've met with over 100 CEOs and CFOs over the last few weeks. You get a really good gauge of which sectors and stocks are performing well. I think there's a huge changing of the guard. A lot of the stocks that fund managers fell in love with 5 or 10 years ago are finding it more difficult, either because of the macro or regulatory threats or competitive dynamics. So you look at Ramsay, CSL, Sonic, IDP, Reece, the list, Domino's, the list goes on. They were the most loved and highest PE stocks in the market sort of 5 years ago, and I think there's a real changing of the guard, and it's a really good reminder for all of us to just have an open mind about, the hottest stock today may not be the hottest stock in 5 years, and then the stock that everyone hates today could end up being really popular. One of the other things we noticed was, healthcare used to be a really resilient and expanding margin story. CSL Ramsay, Sonic have finding conditions more difficult at the moment. On the positive side, I'd say stocks like Qantas delivered really good results. You look at Jetstar, which a lot of people don't sort of think about Jetstar as part of Qantas. That grew earnings 55% over the last year. That division's almost as big as Qantas domestic. So I thought that was really interesting. And Imdex is another stock that I thought was, the market said it was a miss. The shares were down 10 to 15%, but it's an example of a stock where I actually thought the outlook is even better than what I thought going in. And going back to what we were both saying about gold before, the next thing that's going to happen in the market is obviously gold miners are going to go drilling. And if you look at where Imdex, so Imdex, for those who don't know, is the global leader in exploration drilling. The current levels are 40% below drilling activity from the previous peak in 2012. So to get back just to the previous peak, you have to see a 70% increase in drilling activity. And at the same time, they're winning share, they've got new products, and they're moving into production drilling, which is 80% of the market, which they never used to tap. So for me, that's an example of a stock where, in theory, it had a miss and negative earnings revisions, but I think their outlook's even better than what we thought going in.
Yep, at the small end of the market as well.
Yeah, absolutely.
Simon, you're, as James said at the introduction, contrarian. We get some views around that. So you've got to pick your way through reporting season. I think Mark mentioned that healthcare is a sector that used to be a darling, and now it's friendless. Stocks like CSL, Ramsay, which were darlings of the market. Is there anything you're finding in that area? I know you've thought long and hard about both those stocks, something like a Ramsay. Is there value appearing for someone, and you've got to be ahead of the game, so you'll do your work probably a year or so before the rest of us?
Yeah, well, this is the first time ever that CSL is presented attractively to us relative to the broader stock market. It trades at around, I think, 19 times next year's earnings versus the stock market at over 20. And it is growing at mid to high single digits versus the stock market growing at 3 or 4%. So I think things have changed for CSL. Ramsay, we are a shareholder of, and we're a bit early, unfortunately. There's other dynamics at play there, but it's making some progress, just not as fast as people would expect. But one of the big takeaways from reporting season for us was how difficult earnings growth is for companies. So we've had a look at the ASX 100, and cumulatively over the last 10 years, only 8 companies in the ASX 100 have grown their earnings by more than 10% per annum, and they're the companies you would expect: Technology One, Fisher & Paykel Healthcare, CSL's actually one of them, and I can't remember all of the others. But when you look at consensus forecasts, there's 44 companies inside the ASX 100 that are forecast to grow their earnings at 10% per annum over the next 3 years. Any further out is, consensus doesn't look that far forward, so that's why we're looking at 3 years. So there's a lot of growth baked into people's expectations in the stock market, and history has said that earnings will never grow that fast.
Yeah, analysts tend to, as time shrinks, they forecast for 3 years. As they get closer, the numbers generally come down.
Yeah.
But for a value investor like yourself, if we just pick on Ramsay for a while, for a bit, how would you look at that? Because if it does represent value, you say you're a bit early. How do we extract value if it's not around an earnings growth story, which we've all become used to?
No, earnings are a good proxy for cash flows, and all companies are worth the present value of the future cash flows they generate. So I think you need earnings growth. I think for Ramsay, there was a little gem that they dropped with respect to one of their hospitals in WA that suddenly cost investors $36 million next year in earnings that they didn't expect to lose. But there's parts of Ramsay which I think the market very quickly sort of extrapolates very far into the future. It has a French subsidiary called Santé, Ramsay General de Santé, which is worth 2/5 of nothing, and we value it at nothing. But it does get consolidated. It is non-recourse, and a lot of people focus on that. And then, in their infinite wisdom, the previous CFO bought a mental health company called Elysium in the UK, and that is generating a $30 million loss. And I don't think it's reasonable to say that those things happen forever, because if they are continuing, they get closed. So if you start stripping that stuff out, then all of a sudden Ramsay trades at 18 times earnings. And then you think about, okay, fine. Are those earnings high or low? Well, Healthscope has just gone bankrupt. There's a lot of other hospitals struggling. And the rubber band is stretched so far with private hospital profitability and the sustainability of the ecosystem that it's either going to pull back the other way or snap, but something has to change. And in the same way, it's the bus you don't see that kills you. It's the bus you don't see that suddenly turns the corner and gives you a lift home. And those kinds of things can happen to a Ramsay. And it's not a crazy multiple of earnings. The ecosystem is struggling. We need them. It's not about
vital infrastructure. Yep. So, Mark, we're not going to let you get off the couch without giving something positive. Like you might be net zero in Australia, but that means you do own some stocks here. Can you give us some names? They might be special situations that you think, a bit like Simon's talking about there, where there's a bit of hidden value if the management is able to unlock some value along the way.
Sure. I mean, we've got lots of stocks we like in Australia, so don't take my comments as there's nothing good in Australia. That's not true. I just think at an aggregate level, the market's not cheap.
Yep. But you have mentioned to me before something like mineral resources.
Mineral resources we're sort of infamous for rather than famous for. Mineral resources I think is really interesting, and it was one of the highlights of reporting season because they are already delivering at more than 35 million tonnes at Ansell, which is their new iron ore project. They built that in 2.5 years. I know most of my friends couldn't even build their house in 2.5 years, and they built a massive, complicated iron ore project in record time. If you look at the three issues that have been facing mineral resources, I think they're on their way to addressing all three of them. The first is the governance issues, which I think the new chair, Mel Bundy, has done a fantastic job of recalibrating that board and getting them focused on best practice for corporate governance. Second thing is Onslow. They're already at 35 million tonnes. I think there's a good chance they go well beyond that, particularly once the last two transshippers. So they've got 5 transshippers in place. They need 2 more, which they'll get in the middle of next calendar year. That should see them get well north of 35 million tonnes. They'll make about 1.3 billion a year just from that asset, so massive numbers. And then the third thing is obviously the concerns around the balance sheet, and I think those concerns are largely put to bed. The company's been very clear they're not doing capital raising. We think they'll be able to de-gear naturally from their 7 times debt to EBITDA at the moment to less than 3 times within a couple of years. And then there's obviously the option to do asset sales to get that down faster, and the company alluded to that in their results. So we're hopeful that...
You're thinking maybe the lithium business gets spun out?
Well, that's the obvious one because it's not generating much in the way of earnings, and there's a lot of asset value, and you can do look-through valuations versus PLS, and you get some pretty large numbers for the value of that asset, and the market, I think, would view that as a huge positive sign. And bear in mind, you've still got 12% of the register short, and a lot of the people that are short, I would assume, are there because of the balance sheet and the lithium assets. And that would be a huge short squeeze if that was to happen.
Yep, good setup if they get it right. We're going to go to questions in a few minutes, but Simon, I know another stock that's not at that top end, but a kind of mid-cap is Ansell. You think they're doing a great job?
I do, actually. It's at our top end. It might not be at the market's top end, but it's 7% of our portfolio. So, yeah, I think they're doing a really good job. Again, it trades at a reasonable multiple of earnings. It's one of the very, very few companies, bar a recent equity raise to acquire Kimberly-Clark's property, personal protective equipment business. Bar that equity raise, Ansell's share count is lower than it was 15 years ago. So it has perpetually been buying back shares. It has also grown its earnings by a reasonable lick over the past 10 years. You pay a reasonable multiple for it, but it's a boring company and no one cares much for it. But it's those kinds of companies that we think probably protect capital the most and offer the greatest upside from here as well, rather than the others. And yeah, the management team, I think, has done a phenomenal job. Neil Salmon is the CEO, and yeah, he's a very steady, methodical thinker and seemingly very good capital allocator. And if you've got someone at the helm who's stewarding your investment, allocating capital well, I think 9/10 of the job is done for you.
So it sounds like that once you get out of those top 20 Australian stocks, there are some gems down there that you need to. I think you've got to dig deep, Simon. That was your comment.
Or dig. I mean, you don't have to dig too deep, but just go lower than the top 5.
Yeah, and you're a chance at finding something. Okay, well, we might go there with some questions. We've probably got 7 or 8 minutes for questions. All right, so Anonymous, so I'm not sure who this is. What is the most exciting mid-cap stock future potential that you think the market has missed to date? Mark, we'll go with that. You might have already mentioned one, but is there something out there that we've just walked past and didn't recognise?
The two that I think are exceptional are Imdex and NextGen. Imdex, as I said, the market views it, and bear in mind, this is a stock that we bought in at 60 cents. It's already gone to $3, so you sort of feel like it's over. But what the market's missing is that it's shifting to a software business. You know, over 60% of the world's top mining companies use their software. They get real-time drilling data. It creates a massive barrier to entry for competitors. And the mining companies save a huge amount of time and expense from drilling in the wrong area for 3 weeks until their results come back from the lab. So you can charge for that because it's really saving them millions. NextGen I've already spoken about. That's the uranium stock based in Canada. That'd be my 2 picks.
Yeah, okay. Simon, we're going to be a bit unfair. There's a question here. Simon, does value investing work anymore? I don't know if that's fair, but we'll give you a chance to put up a strong defence.
It hasn't worked for some time, but again, I think the maths can't be ignored. And we live in a world where everything is linked, so you can't have the AI companies spend trillions of dollars on capex without expecting a return on that capex. So, or you can spend the $1 trillion of capex and generate no return, in which case the share prices of some of these growthy AI-driven companies is very inflated. But at the end of the day, everything will need a return, and it basically comes back to the consumer. And so I don't see a lot of consumers that have the propensity to keep paying for some of the things that some of this capital investment is expected to generate. And then on the other hand, based on the current consumer settings, other companies are generating reasonable free cash flows today, trade at reasonably low multiples, and we think those companies are quite attractive and those earnings are growing reasonably strongly. Sure, not 27% per annum like NVIDIA, but low to mid-single digits, and those present attractively. So is value investing dead? I hope not. I can't see how that is the case. And these are the types of questions that have been asked at other turning points in market cycles, like at the peaks of the dot-com bubble. We had that in 2021 at the depths of the COVID crisis when Peloton was, however much Peloton was worth. So this is not the first time this has happened. At the end of the day, all companies, it doesn't matter, again, what they do, are worth the present value of the future cash flows. And I think if you can focus on trying to forecast the future cash flows and discounting them back to today, there's no reason why that shouldn't generate a return for investors going forwards.
And just to round out on that, what's the catalyst? In 2021, 22, we had that spike in interest rates. A lot of the growth companies fell a long way. Is that the kind of shock that we need, a recession or an interest rate spike to get value investing back in vogue?
I honestly don't know, but by the time we know, it's too late. And maybe it is just the price-insensitive flows shifting the other way, some outflows from passive, or maybe it's these companies buying back their own shares. There's quite a few companies doing that today, and of course then if you spread an ever-growing earnings stream over a lower and lower share count, the earnings per share tends to go up. It is very hard, but catalyst investing is notoriously difficult.
Yep. But as you said earlier, and pushing back on Victor, the numbers eventually do matter. So,
I think so.
Mark, you mentioned that you've interviewed hundreds of CEOs, CFOs in the last few weeks. Any management teams in Australia that stick out to you as top-notch that others should be saying, well, now there's someone we could emulate?
I'm not going to pick a CEO, but it's a CEO of a division, which is CEO of Jetstar, Steph Tully. As I said before, they grew earnings 55%. If you look at the test case for who has the best business model in airlines in Australia, Rex has gone bust, Bonds has gone bust, Tiger doesn't exist, Virgin went into administration, and Jetstar are doing 55% earnings growth. I think that's a great validation that they've effectively taken the best parts of Ryanair and softened it a bit for the Australian market. And I think that's a winning formula. And I've been really impressed with the way that they communicate with market. And Imdex would be, Paul Howes, who's the CEO of Imdex, I think is an absolute superstar. And I'd encourage anyone, if you get a chance to listen to any of his presentations, to do so.
He's very slick. He's a good guy, Paul.
Excellent.
With maybe just one more, James, is that okay? With a shrinking ASX, I'll aim this one at you, Simon, because you're stuck in the ASX like me. Mark floats around the world. He's got a much more glamorous lifestyle. Shrinking ASX, we've talked about costs too high, regulations hard for listed companies. But for the retail investor, is it no longer the place you should be? Is it a shrinking investment that maybe you've got to look elsewhere?
Yeah, I mean, I didn't know it was shrinking, really, so I'm not so sure about that. But within the ASX are some really attractive companies that are great at what they do, are likely to exist in the next 10, 20, 30 years and be much better and much more profitable companies than they are today. I wouldn't turn your back on the ASX in totality, but if you're thinking about the ASX in an aggregate kind of way and seeking a passive investment to the ASX, I think that would be a hard pass, and giving all of your money to Mark might be a much better option.
Okay, we've actually got room for one more. And both of you might want a quick comment on this before we wind up. Energy. We're going through a massive change in energy globally. In Australia, there's a lot of money for alternates, but we know that we can't really get there without the old fossil fuels and gas and all the ones that are existing. Mark, start with you. Any ideas about energy as an investment and what's available in Australia?
I mean, the Australian opportunity set's very narrow. So you've got Woodside, and then you've basically got nothing, assuming Santos takeover goes through within large cap space. Uranium is the part of energy that we think is the most exciting. If you look globally, everywhere apart from Australia is basically embracing uranium, and demand growth, particularly out of China, is going to be absolutely astronomical. The supply on the uranium side is really challenged. So Cameco just had a downgrade to their production. Kazatomprom, which is the biggest player globally, also had a downgrade. So supply is not even guaranteed to be stable, let alone meet the demand growth. On the oil side, we actually think the outlook's not so bad for some of the Canadian players. They've got really good free cash flow yields. They're using those cash flows for buybacks. There's consolidation opportunities. You're seeing that with Meg and Cenovus at the moment. So I think it's very stock specific. On the oil side, it's not a no-brainer, because we don't think the oil price is necessarily going to do a step change higher unless you saw some sort of geopolitical shock. But I'll give Simon.
So maybe a minute on Woodside, given that's...
Yeah, we own Woodside. Yeah, if oil prices stay where they are today or drift a bit lower, I agree there's not a lot of opportunity. You have to take a view that oil prices would be meaningfully above $70 for certainly any of the Australian space to be attractive. We think that below $70, most oil and gas companies, even globally, are on the mother of all hamster wheels, taking all of their free cash flow and putting it into a hole in the ground, try and replace what they've just produced. And you have the Permian, in fact, US shale in general, seemingly close to rolling over. The only basin doing quite well is the Permian. And even that isn't growing as fast as it used to. I think the backdrop is for somewhat higher oil and gas prices going forwards, but those have been elusive, and it is probably the one commodity or suite of commodities that has underperformed most. And costs have gone up as well as they've done for other commodities. So you've just seen Conoco cut 20 to 25% of their workforce. I think that the next 10 years might be quite different to the past 10, because there's demand on the one side and the cyclical aspects that come with it. Supply is really struggling to keep pace, notwithstanding what OPEC are doing. So we'll have to see.
Well, it took the whole 40 minutes to get them a bit positive about Australia, but we dragged them across the line. A terrific discussion. I'd like to thank Mark and Simon for coming in and carrying the load, given we were down down a person, but you did a great job. I'd like everyone to give the two gentlemen a big round of applause, and thank you very much.